Picture this. Silver drops 15% in a single week. Panic floods the market. But while retail investors are frantically selling at a loss, institutional buyers are quietly accumulating millions of ounces. This isn't a coincidence. It's a pattern that repeats itself every single time silver crashes. And if you don't understand why this happens, you're going to be on the wrong side of this trade every single time. I'm going to show you exactly why every silver crash creates more buyers, how institutions manipulate retail psychology, and why, despite knowing this, retail investors still lose. Stay with me, because what you learn in the next 11 minutes could completely change how you approach precious metals investing. Before we dive deep into this phenomenon, if you're serious about understanding real market psychology and economic patterns that the mainstream won't tell you, make sure you hit that like button right now and subscribe to Empire Economics. We break down the complex financial moves that separate winners from losers in these markets. Now let's get into why silver crashes are actually buying opportunities for the smart money, but traps for everyone else. Silver has always been the volatile younger sibling of gold. While gold moves in relatively measured steps, silver can swing wildly, sometimes gaining or losing 5 to 10% in days. This volatility is precisely what creates the psychological warfare that plays out every time we see a major crash. To understand why crashes create more buyers, we need to first understand what's actually happening beneath the surface when silver prices collapse. When silver crashes, the narrative in mainstream financial media is almost always the same. They'll tell you that industrial demand is weakening, that the economy is slowing down, that precious metals are losing their appeal. They'll parade experts across your screen who confidently predict further declines. They'll show you charts with dramatic downward arrows. And retail investors, watching their portfolios bleed red, panic. This is the exact psychological response that institutional buyers are counting on. Here's what's really happening. Silver, unlike gold, has massive industrial applications. It's used in solar panels, electronics, medical equipment, and countless other technologies. This industrial demand creates a floor price beneath which silver becomes so cheap that industrial users start hoarding it. But retail investors don't think like industrial users. Retail thinks in terms of price charts and momentum. When they see prices falling, their instinct is to sell before it gets worse. This is the first critical mistake. Institutional buyers understand something that retail doesn't. They understand that silver, especially physical silver, has intrinsic value that doesn't disappear just because the paper price drops. When silver crashes below production costs, which happens periodically, mining companies start shutting down operations. This creates future supply constraints. Smart money knows this. They know that today's crash is tomorrow's supply squeeze. So while retail is selling, institutions are backing up the truck. Let's talk about the psychology that makes retail investors lose even when they know this pattern exists. It's one thing to intellectually understand that crashes create opportunities. It's entirely different to hold your position or buy more when you're watching your account value drop by thousands of dollars. This is where emotion overrides logic. And fear is a more powerful motivator than greed for most people. The pain of loss feels approximately twice as intense as the pleasure of equivalent gain. This psychological principle, known as loss aversion, is weaponized against retail investors during every crash. Now I want you to drop a comment below right now and tell me, have you ever panicked, sold silver or any investment during a crash, only to watch it recover weeks later? Be honest, there's no judgment here. Understanding your own psychological patterns is the first step to breaking them. And while you're at it, share this video with anyone you know who invests in precious metals because this information could save them from making expensive mistakes. The historical pattern is undeniable. Let's look at some specific examples. In March 2020, when the pandemic panic hit, silver crashed from over $18 an ounce down to nearly $12 in a matter of weeks. Retail investors were terrified. The world was shutting down. Surely silver was going to collapse further, right? Wrong. Within 5 months, silver had rocketed past $29. Those who bought during the crash nearly tripled their money if they sold at the peak, or at minimum doubled it if they held longer. But most retail investors didn't buy during that crash. They sold. Or they sat on the sidelines waiting for it to go lower. Go back further to 2008 during the financial crisis. Silver crashed from $21 down to nearly $8. Absolute carnage. Retail capitulated. But institutional buyers recognized that the massive monetary stimulus coming down the pipeline would eventually inflate asset prices, including precious metals. By early 2011, silver had reached $48. The patient buyers who accumulated during the crash made 5 to 6 times their money. But again, retail missed it because they were paralyzed by fear during the buying opportunity. Even more recently, in 2021, silver had a massive spike driven by the Reddit Wall Street Bets community trying to squeeze the market. It shot up to nearly $30, then crashed back down below $22 within weeks. Retail investors who bought at the top during the hype lost money. But those who understood the pattern waited for the crash, accumulated positions, and have been positioning for the next move up. The pattern is always the same: crash, retail panic, institutions accumulate, price recovers, retail buys late, price peaks, retail holds too long, crash, repeat. It's a cycle that transfers wealth from impatient hands to patient hands, from emotional traders to strategic investors. So why does retail keep losing despite this obvious pattern? There are several psychological and practical reasons. First, retail investors typically lack the capital reserves to buy aggressively during crashes. When silver drops, they're often already invested and don't have additional cash to deploy. Or worse, they're leveraged and get margin called, forcing them to sell at the worst possible time. Institutions, on the other hand, maintain large cash positions, specifically to deploy during these dislocations. They're always ready to buy when others are forced to sell. Second, retail investors have shorter time horizons. They're often trading with money they might need in the near term, or they're trying to make quick profits. When a position moves against them, they can't afford to wait years for it to recover. Institutions invest with decades-long time horizons. A 2-year wait for a position to play out is nothing to them. This patience is a massive structural advantage. Third, retail gets their information from sources designed to generate clicks and engagement, not to make them money. Financial media makes money from advertising and viewership. Panic and fear drive viewership. Calm, rational analysis telling you to hold through volatility doesn't get clicks. So the information environment retail operates in is actively working against their success. Meanwhile, institutions have research teams, direct access to industrial buyers, relationships with miners, and proprietary data that gives them conviction to buy when headlines are screaming sell. Fourth, and this is crucial, retail doesn't understand the difference between paper silver and physical silver. Most retail silver investment happens through ETFs like SLV or through futures contracts. These are paper claims on silver, not actual metal. During a crash, paper silver can be created and sold in unlimited quantities to drive the price down. This is precisely what happens. Large institutions with short positions will dump massive paper contracts during thin trading hours to trigger stop losses and create cascading selling pressure. The price crashes, retail panics and sells, institutions cover their shorts at a profit, then flip long and buy physical silver at depressed prices. Retail never stood a chance because they were playing a rigged game they didn't even know they were in. Let me break down exactly how a typical silver manipulation cycle works. It usually starts when silver is gaining momentum. Retail investors are getting excited, buying pressure is building. Maybe we're breaking through a key technical level. Then, typically during Asian trading hours when volume is lower, a massive sell order hits the futures market. We're talking contracts representing tens of millions of ounces dumped in minutes. This isn't someone trying to get the best price for their sale. This is someone trying to move the price. The sudden selling overwhelms buy orders, triggers stop losses, and creates a mini flash crash. By the time Western markets open, the damage is done. Sentiment has shifted. The technical chart now looks bearish. Retail investors see the breakdown and sell. The institutions who triggered the crash then slowly accumulate physical metal over the following days and weeks at suppressed prices. This has been documented, investigated, and in some cases prosecuted. Major banks have been fined hundreds of millions of dollars for precious metals market manipulation, but the fines are tiny compared to the profits, so the behavior continues. Retail investors who don't understand this dynamic are simply collateral damage. Now here's where it gets really interesting. Despite all of this manipulation, despite retail consistently losing, every crash genuinely does create more long-term buyers. Why? Because each crash educates a new group of investors about the pattern. Some retail investors eventually figure it out. They get burned once or twice, then they start recognizing the pattern. They become the buyers during the next crash. Additionally, every crash at a higher low than the previous crash creates a long-term uptrend. Smart technical traders recognize this and accumulate during the dips. So the buyer base actually does grow with each cycle, even as individual retail traders get shaken out. Also, fundamentally, each crash that occurs while global debt is increasing, while monetary supply is expanding, while industrial demand for silver is growing, creates a more compelling value proposition. Silver today at $25 with global debt at levels never seen in human history is arguably cheaper in real terms than silver at $5 was in the year 2000. Savvy investors recognize this. So crashes do create buyers, just not the panicky retail buyers who sold. It creates patient, educated buyers who understand the bigger picture. Let's talk about what you should actually do with this information. If you're investing in silver, first, only invest money you won't need for at least 3 to 5 years. Silver volatility requires patience. If you might need that money next year, don't put it in silver. Second, focus on physical metal, not paper. If you can't hold it, you don't own it. Paper silver is useful for trading, but for long-term wealth preservation, physical is king. Third, accumulate slowly during weakness, not during hype. And when everyone is excited about silver and it's all over social media, that's when you should be cautious. When it crashes and everyone declares precious metals dead, that's when you should be buying. Fourth, understand that silver is volatile and that's not going to change. If a 20% drawdown is going to make you panic sell, then silver isn't for you. Accept the volatility as the price of admission for the potential upside. Fifth, ignore short-term price action and focus on long-term fundamentals. Is global debt increasing? Yes. Are governments printing money? Yes. Is industrial silver demand growing? Yes. Are silver mines becoming harder and more expensive to operate? Yes. These fundamentals haven't changed despite price volatility. Remember, at Empire Economics, we focus on the underlying economic forces that drive markets, not the day-to-day noise. Silver crashes are noise. The long-term supply and demand fundamentals are the signal. Focus on the signal. Before we wrap up, let's address the uncomfortable truth. Even after watching this video, even after understanding this pattern, many of you will still sell during the next crash. Why? Because intellectual knowledge and emotional discipline are different things. Knowing what you should do and actually doing it when your account is bleeding are completely different experiences. This is why the wealthy stay wealthy and the average investor underperforms. It's not about intelligence. It's about emotional control and capital availability. If you want to be on the winning side of the next silver crash, start preparing now. Build cash reserves specifically for deploying during the next dip. Decide in advance at what price you'll buy more. Write it down. Make it a rule-based system so emotion doesn't enter the equation. When silver hits your target price, you buy automatically. No thinking, no hesitating, just execute. This is how institutions operate, and it's how you need to operate too. Also, educate yourself on the difference between paper and physical silver markets. Understand how ETFs work, how futures contracts work, how options can be used to manipulate spot prices. The more you understand the mechanics, the less likely you are to panic when manipulation occurs. Knowledge is armor against psychological manipulation. One more thing before we finish. Go ahead and drop a comment telling me what price you think silver will hit in the next 12 months. Are you bullish or bearish? And more importantly, will you be buying if we see another crash? Let's get a conversation going because the community here at Empire Economics is all about real talk and real strategies. And if you found this valuable, share it with someone who needs to hear this. Most people are completely unaware of these dynamics. You could literally save someone from making a costly mistake. The silver market is a battlefield where psychology, manipulation, fundamentals, and timing all collide. Retail investors enter this battlefield unprepared, armed with nothing but hope and influenced by fear-based media. Institutions enter with capital, patience, research, and a proven playbook. The outcome is predictable, but it doesn't have to be your outcome. You can choose to educate yourself, control your emotions, think long-term, and position yourself on the right side of these crashes. Every silver crash does create more buyers. The question is, will you be one of them, or will you be one of the panic sellers transferring your wealth to those buyers? The next crash is coming. It always does. Silver will drop, media will declare it dead, retail will panic, and patient, educated investors will accumulate. Which side will you be on? That decision starts right now with how you prepare, not in the moment when emotion is highest and judgment is cloudiest. This is the reality of silver investing that nobody wants to talk about because it's uncomfortable. It reveals that markets aren't perfectly efficient, that manipulation exists, that retail investors are structurally disadvantaged. But awareness is the first step to overcoming disadvantage. You now know the pattern. You now understand the psychology. The only question left is whether you'll have the discipline to act on this knowledge when it matters most. Thank you for watching Empire Economics. If you're serious about understanding real market dynamics and protecting your wealth, subscribe and hit that notification bell so you never miss our analysis. The financial system is changing rapidly, and those who understand what's really happening will be positioned to thrive while others struggle. I'll see you in the next video where we break down more uncomfortable truths about money and markets.